Well, we're coming to the end of October, and it's not just the Halloween decorations that are getting spooky, it's the stock market too. And the real treats typically come later in the year, more towards the end of October into November and December, where the S&P 500 gets its sugar rush. But there is something sneaky going on that no one's really talking about, the seasonality of the 10-year yield. We'll dive into why this could matter and how it might set up for some sweet opportunities if it starts to pull back. Let's jump in before the ghouls of volatility catch us off guard. You're watching the Stock Market Brief Show. Let's get into it. Well, hello, ladies and gentlemen. I'm back from my little mini vacation. Yes, sirree Bob. Here we go. We're looking at the S&P 500, and it's been a whopping 4 weeks that we have yet to tag the expected move. And finally, on week 5 over here, we did so. There's always a high probability of touching it. All right, so when it doesn't happen for a while, we got to look at the last times that has happened. The last time we went 4 weeks without touching was April of the prior year, and then the market did exactly what it's doing here. We saw a big move outside of it. We saw a big move back and a big move back down, and then a huge move back up. Went up 10%, and then it corrected after the 10% in 2023. It's quite wild. Overall, though, we did see some sell-side activity. It counts as a distribution day in the S&P 500, meaning that good volume came in today as we closed lower. But overall, the structure of the market is still holding its higher lows. So really, we pulled back into what? Well, a prior area of resistance. And that area of resistance came into a prior area of support right here. And we're coming back in and we're holding it once again. Now, there's a 68% probability that we close within the weekly expected move. So earnings that are coming out are going to really make this matter a lot more, especially if the larger market cap names start to bring us outside of this weekly expected move. We'll touch on that in a little bit here. If we take a look at the S&P 500 as far as the sectors that make up the S&P 500, utilities, real estate led the way. These are rate-sensitive names. Tech and consumer discretionary, more risk-on assets were the ones that got hit the most. So the S&P 500 was down almost 1%. The NASDAQ was down 1.6%, and small caps was down about just over 0.5%, while the volatility index shot up. Now, what I find interesting here is take a look at the daily change here, and then we'll look at the week to date. You'll see the real estate and utilities, they led the way, but take a look at 10-year yield and the dollar. So the 10-year yield and the dollar, when they're up, typically you do see weakness in the markets. That's very common. Actually, in fact, look at a week-to-date performance, right? You can see the 10-year yield is up quite a lot, and the dollar is up quite a bit too. And what's going on in the market? Well, a lot of the market is in the red. Now, why does this matter? Well, it goes back to this chart. The 10-year yield has been on a rampant move to the upside. And what I found so interesting today during the live stream was last year in October, from September to October into middle October, the 10-year yield did the same exact thing. It rallied into October 23rd, which put the high in, and then we started selling off. Well, we're right here at October 23rd. And then you date back over to the prior year in October, go look at September through October, and right there in the middle of October to late October, we started finding the high in 2022 as well. So I was like, okay, let's go back another year, right? September to October, right? Boom, we started rallying higher in the 10-year yield, and it wasn't until the end of October where we started to see it come off. Now, this is pretty darn clear in hindsight, but are we going to see something very similar happen? I think that this is a possibility. And it's important for multiple reasons, and we'll show you why in a moment. But take a look here, the dollar. The dollar is a pretty similar situation towards September through October, September through October, September, October into November, right? What's the dollar doing? You see actually a rise in the dollar, and we're seeing a rapid move currently in the dollar. And one would have to think that this move has to get digested. Now, why does these things matter? It's because the correlation. So if we look at the correlation that the S&P 500, this is the SPX, and these are the correlations on different time frames. We got 15-day, 30-day, 90-day, 120, and 180. If you go towards the end over here, these little middle lines are zeros, and you can see on a 180-day basis, right, there's not much of a negative correlation, but there is a negative correlation for the majority of the time. 120-day, you're spending a lot of time here in a negative correlated state. 90 days, negative correlated state. It's when you get to the 15-day and the 30-day, you see more bumping waves here, but what you'll notice is it doesn't stay in a positive correlation for too long. And when it typically gets to a positively correlated state, it'll come back down. So my thought here is if this starts rolling back down into a negative correlated state and say the dollar comes off, that could present a move higher in the S&P 500. Or is the dollar going to hold up, and then is the S&P 500 going to get hit? And that will cause that negative correlated state. Take a look at the 10-year yield correlation. So this up here is the SPX still. And these are the correlations the S&P 500 has to the 10-year yield on a 15-day basis, right? There's this 15-day right here. It's currently positive. And remember, it spends most of its time in a negative correlated state. You see the 30-day correlation right here. Currently, it's positive. Last time it was this positive was back over here. And you can see that it eventually came off. On a 90-day, 120, and 160, it spends the majority and the bulk of its time in a negatively correlated state there as well. So one would think that the short-term correlations are going to come back to eventually meet the longer-term correlations. So that tells me that if the 10-year yield wants to start backing off like it did these prior years, can this, based off of what we've seen taking place here from a week-to-date and daily basis, can these correlations start to go back to what they used to be and potentially create a nice rally into year-end based off of seasonality? Now, where can we potentially go? That's when I look at gamma. Now, the net gamma, what we're seeing here is traders are starting to reach out further. So 6,000 now is the call wall. I'm kind of the belief that we're going to be coming for this. Now, if we get more sell side, I'd be looking at this lower level here as it's been growing in size, and that right there is 57.50. So let's bring up this chart. Right now, the gamma flip line is at about 58.15. So we're floating in and around it. Now, earlier today, it was higher, and we crossed through negative gamma territory, and that, which you'll notice in the VIX, if I've showed you the chart of the VIX, right, during the live stream, if you weren't there, that's okay. Volatility was increasing the moment we started crossing into negative gamma territory. In fact, it happened at 8:10 Pacific Standard Time, 11:10 Eastern Standard Time. So if you go look at the VIX at that specific time, what you'll notice is it went up, came back down, and then it fired off. This is what happens in negative gamma. As dealers sell into the selling, they buy into buying, volatility typically increases. So we saw this flush to the downside and not quite reaching down to 57.50. So we're still holding this level. There's another key level over here at 58.50, but it's not showing that line right now because it's looking at some other ones that are further past 5,900, meaning 6,000 and so forth. So if we get back into positive gamma territory, this would be the level that I'd be looking to retest and come back into and potentially even break higher. When we're in negative gamma territory, this is where I take my foot off the brakes a little bit. So we're basically right there. So it's a time to be more cautious. But more specifically, what else can we look at? We can look at the direction of the 5-day moving average. And now, as you can see, a lot of things are turning red, right? So we have the SPY, the Qs, the IWM, semiconductors is yellow, XBI, and the DIA. They're getting below a declining 5-day moving average. So what would be ideal here is to wait to see this start to flatten out and turn back up. So it might turn yellow, and then eventually price can break back up, and that might create the move that we need to see. So not only are we currently in negative gamma territory, we're below a falling, declining 5-day moving average. So this is a time to be obviously very cautious in the markets until we start to see the markets come back to life. Now, as you see, there's some blue lines on my screen. These blue lines are the quarter-to-date anchored volume weighted average price and or the monthly anchored volume weighted average price because it is October and the quarter started here in October. The Qs undercut it today, which was something that I was looking for. Sorry, the SPY undercut it today, and it started turning back up. The Qs is currently closed beneath it, but with Tesla reporting after the bell, it could very well be above there come tomorrow. IWM currently above it. Now, IWM, interesting here that once we cross below it, it's been below it. But IWM also has a pretty strong negative correlation to the 10-year yield. So if the 10-year yield backs off, rates come down, perhaps that does help out something like IWM2 as well. Okay, let's move on. I want to look at the 15-minute time frame for the SPY. I wanted to just call out that we did come down through the weekly expected move. We undercut that quarter to date, which we just privately discussed. And it's typical to see the move come back in and doodle around. So even on a move higher, there's always a possibility that we come in and we just doodle back right here at the lower weekly expected move and trade within its happy place. If we legitimately start to break through these levels, be very cautious because we may see volume start to really pick up, and selling into selling can cause quite the move in these overall markets. So if we do see that, pay attention to the lower daily move based off of the VIX implied level, which is at 571. The daily expected move, which we definitely went to Sigma today, this is based off of the options chain, the more recent, the near-term expirations. You can see basically tomorrow's expirations, right? 1 day. 574.50 to the downside, 581 to the upside. So this zone is probably where we'll trade down to, or we'll trade up to and around these levels. So that's what I'd be looking for tomorrow as far as the SPY. As far as data that's going to be coming out, we have some PMI flash data, and we have on Friday some durable goods. Okay, so what's the market pricing in? They're pricing in a little bit more of an expected move, nothing too absurd. So we'll watch how price action responds. Now, after the close today, we had Tesla, IBM, Lam Research. They all reported. And, well, take a look at how they're doing. I mean, Lam Research, dang near tagged its upper weekly expected move. Tesla is trading currently above its earnings expected move. CLS traded up into it. IBM is traded down to it. So IBM is the one that got hit, which is, it's not like that large of a market cap. I don't think it's going to have that much weight on the market. Same with T-Mobile. And then we had ServiceNow as well come down into its lower implied move and started bouncing from that point. So as we get into next week, that's when the real earnings are going to start kicking off, right? We're going to get the larger market cap names, Google, right? Meta, right? Microsoft. We're going to start getting some massive names going through the heat of earnings season. And that's going to really expand these implied moves. Including all of that, we're getting closer and closer to the election. And there's just a lot of volatility here being priced in. I took a look at the VIX on the intraday chart, VIX futures, and we were in backwardation, which just tells us that, the market is seeing things that can happen right now, less so out into the future and prior contracts further out. So once again, we're going to be monitoring that and seeing how that goes. The main thing that I wanted to cover here today was the seasonality of the 10-year yield, how it's risen in September into middle of October, and then all of a sudden it started coming off. And we're coming to the exact day where we hit these prior highs almost like by a day or two. So it's going to be interesting to see that if the 10-year yield is going to start backing off, is this little shakeout here in the Qs and in SPY, is this just another pullback to eventually go towards that 6,000 where other traders are reaching to? Till then, let's be cautious. We're under that declining 5-day moving average, and we're right there at about negative gamma territory. So be careful, be safe. Hope today's episode helps you out. See you later.